India's mutual fund industry has grown at an astonishing pace over the past decade. It's been fueled by many more retail investors, the rise of digital platforms, and a boom in new products. And this is a seminal moment as far as our markets are concerned. Atmanirbhar stock market with millions of Indian investors joining in through multiple products, including SIPs, which allow for smaller ticket size investment also to happen. And this is a fascinating development, a pivotal moment in the Indian market, which is buffeted by lots of global challenges. And joining us today is one of the most well-known fund managers in India, one of the top really in this country as far as mutual funds are concerned, Rajeev Thakkar, the CIO of PPFAS. And he joins us to give us a perspective on market trends, evolving investor behavior, and what the future holds for India's mutual fund investors. Rajeev, a very warm welcome. Happy Diwali to you and all your colleagues and wider stakeholders. I'm going to begin by asking you to sort of explain to our viewers, in such a market as we see, what is the core investment philosophy that balances conviction in fundamentals with the appetite for short-term themes and high beta plays?
Thank you so much, Siddharth. Wish you and everyone at Business Today a very, very happy Diwali, and happy Diwali to all the viewers and readers of the group. Wish everyone a very, very prosperous new year. While it's traditional and obviously one takes a relook at where one stands periodically, and a new year is a appropriate time, as it were, to take stands and where we stand and what is the outlook. But typically the life situations, goals, aspirations, risk appetite of investors don't change within a 12-month period. At best, some small tweaks may be required here and there. So to your question as to how does one balance the longer term fundamentals and convictions with the shorter term noise, as it were, in the marketplace, be it the themes and trends that play out, or be it the headlines that are there in terms of tariff on, tariff off, geopolitics, war-like situations and things like that. My recommendation would be to have a very, very small allocation to these tactical things that people do, either go overweight equity or underweight equity in terms of their asset allocation. Bulk of the investing should be driven by their life situation. So I wouldn't recommend a 70-year-old requiring monthly cash flows to be heavy in equity, and a 25-year-old with a very, very long investing career ahead should be equity heavy despite the noise. So I would recommend tuning out of some of these headlines that concern us on a day-to-day basis.
That's a very, very important point, and a day-to-day investor has a different set of priorities, as you point out. But let's also take this point that you make and take it a little forward. If you see the story of the Indian market over the past 1 year, you could describe it largely as sideways movement. Now, when we take a broader long-term outlook, how should an investor also read the prospects of the market for the new Samvat?
Sure. So Siddharth, you and I have been around for a while now, but a lot of investors have been relatively new to the market. Just for context, pre-COVID, we had about 4 crore demat accounts, and today that number stands close to 20 crores. Now, some of this would be duplication, but nevertheless, a lot of new investors have come into the markets. Even in the mutual fund space, the number of unique investors have grown quite a bit. So a lot of people haven't seen sideways market, and they are surprised by the past 12-month market performance. I would like to point out to this new set of investors is that equity by nature has this kind of a trend. There are some years of superlative returns, very, very high returns. There are some years where market goes nowhere, or in fact, market falls as well. In fact, when I started off in mid 90s, we had a period from 1992 to 2003, where over a 11-year period, the at the index level there were negative returns. So, recommendation one is invest only that money into equities which you can stay invested in for a period of at least 5 to 7 years. And overall, in terms of the outlook for the next Samvat year, while flows have been strong, we have seen regular SIP flows coming in, lump sum investments, a lot of fundraising activity happening via IPOs and follow-on offerings. At the same time, we have seen a subdued appetite from foreign investors. Now, there is no reason for foreign investors not to like India, because at the macro level, everything seems to be all right with India, and uh, we seem to be growing quite well, even though we are a relatively large economy now. However, there has been a big disconnect between valuations that prevail in India and the valuations that prevail globally. While GDP growth has been strong, uh, the corporate profitability has been weak. And I have a hypothesis around this, that even in sectors which are seeing reasonable amount of volume growth, the competitive intensity has been at a very, very high level. So newer players are coming in, existing players are fighting for market share. People are wanting to grow their sales even at the cost of profitability. So to take examples, let's say paints, which was a three player market, has become suddenly a six-player market. Uh, Big box retailing or the quick commerce, there are maybe 10 players fighting it out. Everyone wants sales growth. People are okay to sacrifice margins. So, in the absence of earnings growth, the stock price performance is subdued. So, ultimately, stock prices are slaves of earnings, and earnings have been disappointing.
Absolutely, and disappointing earnings is clearly something that impacts both valuations and confidence. Let's speak for a moment about valuations. Now, uh, Indian equities continue to command a significant premium as compared to peers. What's your own sense? Is some sort of recalibration underway? And as far as the growth potential of India's market is concerned, some guests on our shows come and tell us that don't even ask this question, because when you compare it with other markets which are far lower growth markets, you should not compare it with the Indian situation, where in some ways this premium is on account of future anticipated growth. Where do you stand on it, Rajeev?
So, Siddharth, I have a very, very simple answer to those who make this point that India's growth rate is higher. One, uh, today the country of listing does not necessarily reflect in the underlying business. So we have enough companies listed in India which have huge global operations. So Tata Motors in India owns Jaguar Land Rover, Hindalco owns Novelis, Tata Steel owns Chorus. So Indian companies are also multinationals. And while one can argue that India's growth rate is higher or could be higher, depending on one's views, a situation where if you buy the global parent, the entire India market cap is accounted for a small portion of that, and the rest of the global business you get free. That situation is clearly an anomaly. You cannot explain that away by uh, India's high growth rate. To clarify this, let us say the value of India's operations of a global multinational is 100 as per the market cap in India, and the global company is trading at a market cap of 120, then there's clearly something amiss. If you buy the global company, you get the India operations, plus for a very, very small amount, you get their global operations as well. So sometimes the valuation differences have been very, very stark.
Absolutely. In fact, when you were saying that, I was reminded of recent examples where the Indian arm of a MNC, and we've seen how they have listed and their market cap gains, and also that many companies are now favoring investing in India and having a listed operation because it provides investors back home a greater comfort. Since we spoke about the global part of it, you are among the few Indian fund houses who have maintained a global exposure in their portfolios. How are you currently placed as far as global allocation strategy is concerned, and is there any recalibration that is underway or that you foresee in the forthcoming months?
So the entire mutual fund space has been constrained for about 3+ years now. So some of the viewers and readers may know that RBI has a $7 billion limit overall for all the mutual fund houses put together. That 7 billion amount is what people can remit out to invest in global stocks. This limit got hit sometime in February, March of 2022, and since then, more remittances are not happening. So, given that kind of situation in our own fund, gradually the overseas weightages have been coming down. As on date, we have about 11% exposure to global stocks, and we plan to continue to hold this over a period of time.
All right. Let's now turn to another element of our conversation, and this is about overall behavior as well as investment preferences and choices of investors. Before I get to sectors and opportunities, I also want you to tell us, do you think the recent number of investors joining, the amount of inflows at a time when foreign investors have pulled out of the market, is this evidence that Indian investors and the Indian market is maturing, or is this a bit of overconfidence in equities?
Siddharth, I would say a bit of both. So at one end, SEBI data shows that last financial year we raised probably 1.7 lakh crores via IPOs, or roughly $20 billion. So this is a good sign. Capital formation happening in the country. Young demographic, more savers as compared to retirees. The growing SIP book, EPF money coming to the markets, NPS money coming to equities. People getting this equity culture because of ESOPs with their employers. Financial literacy efforts of AMFI and various bodies. So all this is the positive part. However, the flip side to this is that while we raised 1.7 lakh crores of rupees in IPOs, uh, speculators collectively lost 1.06 lakh crores via F&O transactions.
Absolutely.
So that gambling instinct is also there. Bulk of the trades today are of a gambling nature on the stock exchanges rather than any thought out capital formation or long term wealth creation strategy. So that is something which is to be uh, kept in mind, and one should be cautious on that, and regulators are also aware of this and trying to bring down the temperature on that side of the market. And while it may seem that this trend towards financialization, trend towards equity investing is irreversible, but as we spoke earlier, a lot of these investors are new to the marketplace. They haven't seen a down cycle. Today, if you were to look at the social media chatter, already talks are there that 1 year equity returns haven't been that great. Maybe we would be better off buying something like gold or silver. So a lot of the uh, asset allocation decisions, unfortunately, are taken by last 12-month returns or last 3-year returns rather than as a well planned, thought out strategy.
Rajeev, you spoke about hyper competitiveness in an earlier answer, and you kind of mentioned a couple of sectors. So I want you to now look ahead for us, because you are absolutely right. Looking backwards doesn't make any sense. What do you think will be the key sectors to watch out for, even for those who are investing in the markets through fund managers like you?
So, one sector which hasn't really participated in the up move, or where valuations as compared to the historical averages look reasonable, has been the banking space. Here, uh, sentiment has not been that great. Uh, IT services, the consensus opinion is that a lot of headwinds, global captives are coming here, effect of AI on the amount of work that will be there, and resultant impact on margins, etc. Growth rates have been very, very subdued. However, in the past as well, we have seen the sector go through cycles of cycles where some periods are very, very high growth and some periods where the growth is subdued. So I think these two spaces look reasonably okay to identify individual opportunities. Select PSU or utility kind of names look reasonable. After the GST cuts, auto sector has been seeing a good amount of volume growth. However, one has to finally uh, look at the individual company valuations. A lot of these things that I'm talking about, things like improved demand in auto, is probably already reflected in the stock prices. So one has to be selective and wait for the right opportunity to come by.
Is there a possibility of a shakeout in some of the sectors which are hyper competitive right now? You spoke about that, but we saw that, for example, in telecom over a period of time. But is that also something that we need to factor in?
Oh, absolutely. In a lot of sectors, there's not enough space for so many players. So, talking about the sector in which I work, asset management companies. So, you are seeing applicants coming every month, newer and newer AMCs setting up. You look at discount stockbrokers; those guys are getting set up every passing month. Wealth management, quick commerce, organized retail, sector after sector, you are seeing more and more people enter the market. There will be a shakeout. Early 90s, also, we had seen this kind of a situation where every corporate house wanted their own NBFC. We are looking at similar trends. The number of NBFCs that are being set up and coming to the market for fundraise. The well-run ones, of course, will do well and create wealth for shareholders, but some people, unfortunately, will have to exit the market.
It's interesting you speak about NBFCs, because currently we have seen a big headline play out, which is the listing dispute for a upper layer NBFC that is playing out. We don't know when, as and when that gets resolved, and if that were to list Tata Sons, that will also be a important moment for the market. Since you spoke about fund management, I want you to continue to expand on that, with the question being that how do you see fund management evolving in India for the next 5 years, and more importantly, what do you think is required for fund houses to stay relevant?
So, one trend which has played out globally and which also will play out sooner or later in India is the trend towards passives. So, passives will definitely carve out a share in the Indian market. They are already here, but the uh, balance between actively managed funds and passively managed funds could tilt slightly towards passives more as compared to the market share that is there. Product wise, I think we have a very, very standardized product offering in the marketplace. So there is strict categorization at the SEBI level in terms of a large cap fund, mid cap fund, large and mid, uh, money market fund, liquid fund. So those categories are well defined and stringent. So those are very, very standardized products. Now, beyond a certain number of schemes from different fund houses, there's not much of differentiation that can come in. So, from that point of view, one could see some consolidation down the road. Of course, there will be individual managers, individual funds which will do well in terms of a differentiated strategy, but that will be a certain pocket of the market. Overall, I think we are moving towards more standardization and down the road, some kind of a shakeout.
No, that's an important point. Down the road, some kind of shakeout, because I'm sure many of our viewers know this. Around 1,800 funds, and incidentally, the business today, India's best mutual fund edition is around the corner, right after Diwali, and hopefully an edition that will provide clarity to investors. I want you to add to that point on clarity. See, when we talk to a lot of people, especially the newer set of investors that you also referred to, they say that there are just too many options, and at times it becomes difficult for them to figure out active equity funds, ETFs, thematic products. As a market master, really, Rajeev, what would you say to those who might be listening in? How should that investor build a investment portfolio without getting overwhelmed and confused?
Sure. So first decision does not even involve selecting a mutual fund scheme. I think where people make a mistake is getting the broad asset allocation right. How much into equity, within equity, how much domestic, how much overseas, how much into fixed income, precious metals, real estate, whatever the asset classes that are relevant to the investor. I think people make a fundamental mistake here itself, even before coming to the mutual fund schemes. When it comes to mutual fund schemes, if someone is new to the investor, and even in my view, people who have been around for a while also would do well in terms of selecting diversified equity funds rather than going with very, very specific thematic funds or sectoral funds. Uh, Firstly, there's no clear indication as to which sector theme will do well in the near term or medium term. Uh, Typically, these funds catch fancy after a period of strong run up. So, investors end up doing badly by selecting some sector or some theme. As long as people invest in a diversified fund, either via something like a flexi cap or a multi cap, or by selecting large, mid, and small cap funds, they should be okay. One caveat I would like to recommend is don't go overboard on small caps and mid caps. Uh, these are smaller companies where the fund will invest. They are by nature more volatile than the more established companies. The profit pool, roughly 65 to 75% of the overall corporate India profit is concentrated into large caps. Mid and small caps have a smaller profit pool. So allocate money accordingly and don't go overboard in the small cap space.
Rajiv, you've spoken about this in the past, and I want to bring that back again for the benefit of those who may not have read and heard you on this, which is the value of patience, simplicity, and integrity in the kind of hyperactive lifestyle and investing philosophy and investing on the go. Because of the ease of digital investing, a lot of people end up making choices. Once again, for our viewers and readers, how critical are these values, and for those who might want to imbibe that, what should they be doing to actually become patient and organized investors?
So at the reception area of our offices, there are these things that are put up. So one of the sayings that is there in our reception area is that good things take time. So people who, let's say, sign up for education take about 20 years to graduate. They graduate at the age of 20. Uh, the infrastructure work that is happening in our cities. So we waited for many years in our city of Mumbai to see the Metro Line 3, Aqua Line getting completed and us having the benefit of using such a vital piece of infrastructure. So anything worthwhile needs time. And in that journey, there will be progress some of the times. There will be stoppage in between sometimes. So there were disputes, for example, in the Metro Line 3 as to where should the car shed be located. And that delayed things a bit. So these are par for the course. Whenever you invest in an asset class, say something like equities, you will have a period like 2025 where it will be a sideways market. You could have periods like 2008 where there's a severe downturn, or period like 2020 because of the COVID situation, a downturn. And you will have situations like 2003 and 4 where there was a very euphoric market. So unless one has the patience, discipline, and some kind of calm temperament, it's very difficult to generate wealth from equity as an asset class.
Absolutely. As we wind down this conversation, two quick points to understand from you. One, what is your own sense about continuing SIP flows which have held up the market at a time when foreign investors, and we really don't know when they're going to come back like in the past. In fact, I want to hear your views on that as well. So how long do you expect inflows to continue at this rate? And if the Indian economy is projected to grow at whatever rate, do you think the inflows will also follow that similar trajectory?
So inflows have two components. One is the structural component and the other is the cyclical component. Structural component is driven by our demographic, lot of people joining the workforce, saving for longer term goals, retirements. So SIP book is only one part, but NPS money coming in is a very regular feature. EPFO investing in equity is a very regular feature, and those kind of things will continue to happen. In a sideways or downward market, I would expect some kind of impact on the growth of SIPs, or maybe there could be some stoppages along the way. But I think as long as collectively the investment banking community, the corporate promoters and investors, as long as we behave responsibly, don't take valuations to very excessive levels, I think foreign investors will also come back as and when they see an attractive opportunity. I would be broadly very optimistic longer term, but there could be hiccups along the way.
Okay. My final question today, and you touched upon it, but I want to recap that once again for the benefit of all those who are watching and will read us, which is the ideal portfolio mix. Now, obviously, you touched upon it. It also depends on your age profile and at what stage and station you are in your life. But considering the profile of the average investor, the mutual fund investor, that you see, the data that you see, what is the ideal portfolio construct that they should have?
Sure. So one, historically, gold has always been part of our cultural thing. Most people will have gold in their lockers at home or in their bank lockers. I would urge not to rush into gold just because past performance has been good. So that is one thing people should be mindful of. Be mindful of not over allocating to themes and small cap, mid cap kind of things. Otherwise, the overall asset allocation, as you mentioned, will take into account the age, the financial goals, and risk appetite of people. In the West, people use a thumb rule, 100 minus the age, they take that as the equity allocation. It may work for some people, may not work for some people, but that would give some kind of a rough indication. At the younger ages, more equity; towards retirement or in retirement, a smaller portion of equity.
Okay, Rajeev, there's so much to unpack, but you've clearly given us some clear-cut views and guidance, especially for those who are coming into the age of mutual fund investing or investing via mutual funds, and you made it clear what you see as the possibilities that will play out. As I thank you, I once again remind our viewers that mutual fund investing has become far more easier in India than it was many years ago, and we will continue to see that evolve. The industry has evolved, and in all of this, making the right choice and deciding where to allocate your capital is the fundamental, and views from Rajeev Thakkar will help you do that. Please do make sure that you pick up a copy of the annual Business Today mutual fund guide, because it will help you in your investment journey to save, invest and prosper. Rajeev, thank you very much, and once again wishing you and all your colleagues and family a very happy Diwali.
Thank you for the opportunity. Happy Diwali.
With that, it's a wrap. We'll be back. Until then, goodbye.
A luxury bus that suddenly turned into an inferno. Over 20 lives just gone like that. Many injured. Their devastated